Hi everyone, I'm Devon Coombs, and today I'm going to go over journal entries for accounts receivable, which are just services performed but not collected. So this is going to be for service revenue rather than for merchandise revenue. We're going to go over merchandise revenue and inventory in other videos. So let's dive straight into it. So the fact pattern is between December 1st, 2019 and December 31st, 2019, Coombs Inc. performed $3,000 of services on a time and materials or T&M basis. Coombs Inc. billed for these services on December 31st, 2019, but did not receive payment for any of these services until January 31st, 2020. And so this is very common in consulting companies or professional service companies to perform services and then have delayed billing terms. So in this situation, I'm performing a service. If I'm the consultant, I'd be performing $3,000 of services in December, but not bill for those services until the future. Customers like this because they can wait to pay for it until they're satisfied with the services, but collectability is assured. We are contractually able to bill for these just later. Since we billed for these on December 31st, even though we're not going to collect on them until January 31st, we do have an asset based on the revenue recognition principle, where we recognize revenue as the performance obligations are satisfied. So another way to put that is as we're earning the revenue, we can recognize it. And so we're going to be debiting accounts receivable. That's based on GAAP accounting, right? This is no longer cash basis. So debit accounts receivable for $3,000. Accounts receivable is an asset. Assets have a normal balance of a debit, so accounts receivable is increasing by $3,000, and our sales is also going to increase. Our sales are going to increase by $3,000. Sales are revenue. Revenue has a credit normal balance, and so then our debits equal our credits, which we'll see here. So our debits equal 3,000, our credits equal 3,000, and so we have current assets of 3,000 and revenues of 3,000. So that's the first part of the rules of accounting, are that our debits equal our credits. So we're okay there. And then let's see how that impacts the financial statements and eventually the accounting equation. So in the financial statements, our revenues now have increased based on that sale on credit. So we're effectively offering credit terms to our customer. And so our revenues are going to increase even though we haven't received cash. And so our revenues increase, which increases our net income, which then in consequence increases our retained earnings here. And so this is always the flow, right? We make our income statement and we increase our retained earnings. To see all of these other financial statement adjustments, just watch the previous videos. They're all in order, so you can see how we build a company's financial statements from the ground up. And then after the statement of shareholders' equity, we build the balance sheet, right, which is just the accounting equation. And so I've made it in the accounting equation format for the earlier videos. Later, we're going to make it in the regular balance sheet format. So our cash hasn't increased, but our accounts receivable or AR has increased by 3,000, as this is an asset and it's going to be in order of liquidity. So cash is the most liquid asset, then AR is the next most liquid asset. This is assuming we're expecting to collect all of our AR. I'll go into bad debt and accounts receivable reserves in future videos. Then we have our liabilities, which is our deferred revenue of $5,500 from our previous video, and then our equity, where our revenue has now increased our retained earnings, right? Our net income flows into our retained earnings. So for the first period of a financial statement that's been issued, your retained earnings or accumulated loss is going to equal your net income, and then as net income less your dividends. And then as your financial statements grow, it's going to be the accumulation of that impact. So remember, what we have is equal to what we owe and what we own. And so our cash, our AR, prepaid rent, and our net equipment, all of our assets have been either funded through our deferred revenue services we owe, or through our operations, our retained earnings, which was just increased from the sale on credit or the performance of services on credit in the form of accounts receivable, and our owners' contributions or the common stock issuance. And then the next accounting rule, right? The two accounting rules, debits always equal credits, and then assets always equal liabilities plus equity. We can check here that the 5,500 plus the 17,950 equals the 23,450, which means we're creating our financial statements correctly so far. And then lastly, we have our statement of cash flows using the indirect method. The direct method is in the statement of cash flows video, and so we can see how this has been adjusted based on this one transaction. And so we add this line, accounts receivable, and it's going to reduce our net cash provided by operating activities by $3,000. And this makes sense if you think about it, because we didn't receive cash and our net income has increased. And so in order to reconcile net income to the cash that's been provided by operating activities, we'd have to reduce it for the accounts receivable. Another way to remember this, that is, if short-term assets increase, we're going to reduce it from our operating activities in the statement of cash flows. But the logical way and the theoretical way to solve this is the fact that we haven't received cash for these accounts receivable, but that's been included in our net income, so we have to decrease it to determine our net cash provided by operating activities. And then our checks here are, does net income tie to the income statement? Does our beginning cash tie to beginning cash? And does our ending cash tie to ending cash, or agree to it? So we had no beginning cash at the beginning of our business, so that's not an issue. Our net income, $7,950. We know our net income here and our income statement is $7,950, so that ties. And then we check our balance sheet. Cash is $16,200 right here, right? $16,200. So that should be our ending cash here, $16,200. And so this gives us a great picture of how the business is doing and how, even though we may have income and revenue from our accounts receivable, it's not going to affect our cash flows. And some investors will look on this negatively, right? Many investors care more about how you're able to produce cash than how the GAAP financial statements work. So always be thinking about these critically. I hope this video was helpful. Our next video, we're going to talk about a little more complex subject that arrived from the new revenue recognition standard, ASC 606, contract assets and unbilled AR for services. And that's going to wrap up our introductory revenue journal entries. And we're going to go into some supplies entries after that. So thank you for watching. If you have any questions or would like any other videos, feel free to add comments below. Thank you very much and have a great day.